Welcome back to the Deep Dive. Today, we're really getting into the weeds on a couple of finance problems that I think plague pretty much any modern global citizen.
Yeah, that's right.
Specifically, why your traditional bank seems to hate it when you travel, and then how you can get genuinely meaningful returns on your stable assets. We're talking something like, what, 20 times the yield you'd see in a standard savings account?
Exactly. And we've pulled together some fascinating sources for this dive. We've got these detailed educational frameworks, a breakdown of a 2026 blueprint for low-risk passive income, and even a traveler's guide to crypto payment cards.
And the theme connecting all of it seems to be overcoming this deep, unnecessary friction that's just built into the legacy financial systems.
That's the core of it, freedom and yield.
Our mission today is pretty simple then. We want to give you the practical knowledge to solve two massive problems. So first, how do you travel the world without, your financial life collapsing at every border?
A very real problem.
And second, once you've sorted that out, how do you put your dollar-pegged stable assets to work so they're actually earning you a real income?
Okay, so let's unpack this. We have to start with the problem itself, because the pain points for global citizens, for digital nomads, they're severe.
They really are.
The data we looked at paints a pretty stark picture. I mean, traditional banks are, frankly, fundamentally hostile to people who cross borders a lot or live nomadically.
It's astonishing, really, how stuck in the past that infrastructure is.
Yeah.
And when you look at the incident reports, it's not just a minor inconvenience, not at all.
No.
We see constant accounts of banks, blocking payments, freezing accounts just out of the blue the moment a user leaves what they consider their primary zone.
And this isn't a glitch, right? This is a feature. It's part of their cross-border compliance that just treats every single international transaction as suspicious until you prove otherwise.
Exactly. I saw one report detailing a traveler who, I think they're locked out of their funds for 72 hours just for flying from London to Singapore.
72 hours. Yeah. That's the reality of what our sources are calling constant cross-border friction. It's a systemic failure. The whole centralized card infrastructure it sort of collapses when it hits an international boundary.
But the truly crippling hurdle, the one that really stood out to me for anyone living globally, is this concept of being trapped by proof of residence.
Ah, yes, the big one. Traditional banks demand local documentation. Utility bills, leases, things that tie you to one specific address.
So if you're traveling for a long time or, truly living between nations, you just can't open new services or maintain them.
It's both. But the struggle to open new accounts is the real strategic failure. You try to open an account in a new country, and the first thing they ask for is proof that you live there permanently.
Which you don't have.
Which you don't have. It forces people into this perpetual state of financial instability where they're totally reliant on a single aging account back home.
Which, as we just said, is probably going to get frozen anyway.
Exactly. It's a deliberate geographic restriction that, digital finance is specifically designed to bypass.
The whole system just feels so archaic. So how exactly does the decentralized solution get around these traditional bank gatekeepers? This is where it gets really interesting for me. How are crypto cards positioned as the solution to this whole cross-border nightmare?
Well, the promise is actually quite elegant in its simplicity. The freedom of crypto cards means the asset conversion, so from crypto to the local fiat currency, it happens instantly on the back end.
On the back end.
Right. They're just using networks like Visa or MasterCard as the rails. But crucially, the central bank that issued your card is no longer the one deciding if you personally can spend money based on your location. The funds are drawn from your self-custodied wallet.
Okay, that makes perfect sense for speed, but let me push back on that a bit. If the card relies on converting crypto, what happens when network transaction fees? The gas costs, what happens when they spike?
That's a critical question.
Does that no hidden border fees promise get undermined by unexpected costs on the crypto side?
It's a great point, and this is exactly why the best cards use these highly efficient, low-cost Layer 2 solutions, or specialized payment networks where the conversion fees are. Well, they're negligible compared to the typical 3% foreign transaction fee a bank would charge.
So the goal is for the user to just see three things.
Yes. As the Traveler's Guide laid it out, you want worldwide acceptance, seamless compatibility with Apple Pay and Google Pay, and genuinely no hidden border fees.
And we saw a specific example of this, a solution built for this kind of global movement, PintoPay. This card was presented as this independent modern card works in over 150 countries with zero border friction.
Right, and that example really helps us understand the whole landscape because based on the patterns we saw in the data, these cards really fall into three main categories, and understanding these categories is essential because they all represent different trade-offs for the user.
Okay, so give us the breakdown of those three types, because that choice seems absolutely fundamental for a traveler.
For sure. So first, you have your exchange-based cards.
Right, the ones tied to a platform. Coinbase, Binance.
Exactly, tied directly to a large trading platform. They're convenient if you already hold your assets there, but their primary limitation is that they're often geo-restricted.
Ah,
So if you're a U.S. resident, your Binance card might not work, or vice versa, because the exchange itself is navigating these really complex global regulatory fences. They serve their existing users, but they aren't truly borderless.
so you get great rewards for staying loyal to one platform, but it's a high-risk strategy if your travel is actually unpredictable.
Precisely. The second type is the fintech card, like that Pinto Pay example.
The independent ones.
Yeah, they focus entirely on user experience and global movement. They aren't tied to an exchange. They're built specifically as a payment layer.
So what's the trade-off there?
Well, their trade-off sometimes is that they might lack the deep fiat off-ramps or some of the specific local banking integrations that the major exchange-based cards have in, established regions.
Okay, so they solve the movement problem, but funding them might take a few more steps.
Exactly. And then the third type is the white label infrastructure.
This one isn't a brand you use directly.
No, it's the technological backbone. It's the platform that other brands, maybe smaller regional financial companies or niche travel companies, use to launch their own branded crypto cards.
So if you see a new, unique card pop up,
It's likely built on top of a tested white label foundation. And, recognizing this helps you evaluate the underlying security and reliability of a new product you might see.
that gives us a really clear decision framework for spending globally. Now, let's pivot from spending power to earning power. We've solved the friction problem. Let's talk about the returns problem.
Okay.
We know traditional bank accounts, they often give you less than, what, 0.5% interest? The data we reviewed, specifically this 2026 DeFi blueprint, it shows opportunities targeting 20%.
Yeah, and this is where the concept of capital efficiency just becomes so important. You might be holding stablecoins, which are pegged one-to-one to the US dollar, so they have the stability of cash.
But if that cash is just sitting there,
It's losing value to inflation every single day. The blueprint basically asks, why would you accept 0.5% when open, decentralized markets are offering significantly more just by putting that dollar to active, productive use?
I mean, a 40-fold increase in potential return is staggering.
Yeah.
So what does this strategy in this 2026 blueprint actually entail? How do we get to that 20% APY target using, low-risk stablecoin farming?
Okay, so the blueprint focuses on audited protocols that generate what's called real yield. And this requires a really crucial distinction.
Okay.
We are not interested in inflationary token farming. Real yield is different. It's generated by protocols that charge fees for useful, necessary economic activity.
Like what?
Things like decentralized lending, automated market making, which is just trading, or even structured derivatives.
Can you walk us through what that real yield mechanism actually looks like? I mean, how does a protocol generate $200 for every 1,000 I put in without just printing new money?
Think of it this way. When you deposit your stablecoins into a decentralized pool, you are providing liquidity for traders or for borrowers. The platform uses that liquidity to facilitate activities.
Okay.
So, for example, the protocol might charge a tiny fee on every single trade that happens in that pool. That fee, which is real revenue, is then distributed back to you, the liquidity provider,
And it's paid back in the stablecoin itself.
in the stablecoin itself. Other sources could be interest paid by borrowers or even liquidation penalties from under-collateralized loans. The point is, it's revenue generated from actual economic activity, not from inflating the supply of some governance token.
That makes the critical difference, because inflationary token farming, while it might show some crazy 200% APY number, it pays you in a governance token that could, plummet in value by 90% in a month?
Absolutely. So your yield just disappears.
It's not real.
It's not. You're paid in tokens that might have no inherent economic backing outside of, the hope for future profit. The real yield protocols are built on sustainable fee structures. That stability is what allows the blueprint to suggest a 20% target as low risk for this asset class.
Provided the underlying smart contracts are audited and well established.
That part is non-negotiable.
Let's talk about opportunity cost, because this is the connection for our listener. We know savings accounts give basically nothing. So if I put $1,000 into a bank today versus deploying that same thousand into audited stablecoin pools targeting 20%, what is the opportunity cost I'm losing to inertia over just 1 month?
Well, if your $1,000 is sitting in a standard bank at 0.5% APY, you're earning less than 50 cents in passive income.
50 cents.
In the current inflationary environment, that money is effectively shrinking. Now, if you successfully deploy that same $1,000 into the stablecoin pools, targeting 20% APY, you're looking at earning around $16 to $17 in that same month.
Wow.
The opportunity cost is staggering. You are foregoing a monthly income of $15, $16 purely because of inefficiency. It fundamentally changes the calculation of whether it's worth it to move your capital.
This isn't just about maximizing returns then. It's about making sure your savings aren't being penalized by these outdated systems.
Yeah.
So let's zoom out to the broader decision framework. We've covered global spending solutions. We've covered passive income opportunities. How does a learner approach these options without just falling into, analysis paralysis?
The educational framework we saw really emphasizes context over dogma. There is no single best option in this space. It just doesn't exist.
Right.
Every solution, whether it's the specific type of crypto card or the yield farm you choose, it has trade-offs, and those are rooted in the underlying technology and the security model. The choice depends entirely on your needs and your risk tolerance.
So if you're traveling constantly through regions with, say, limited fiat off-ramps, you might prioritize a fintech card over an exchange-based one, even if that one offers flashier rewards.
Precisely. And if you're seeking low-risk income, you absolutely must dedicate time to vetting for that real yield structure and looking at the smart contract audits rather than just chasing the highest advertised percentage.
The goal is to empower people to understand their options.
Exactly. To understand all your options, to explain how the yield or the card friction is being solved, and crucially, to set realistic expectations.
So essentially, we've connected these two problems that the traditional system just couldn't solve. How to spend your money seamlessly when you're traveling, and how to make that same money generate meaningful returns when it's idle.
And both require abandoning the geographic and the technological limitations of centralized banking. They also require the listener to become a much more active participant in their own finances.
You can't delegate the risk assessment anymore.
No. Understanding the mechanism behind the reward, be it trading fees or lending interest, is just as important as checking a card's global acceptance.
We've definitely covered a lot of ground today. To synthesize the key knowledge nuggets, the failure points of traditional banking are systemic. We're talking card freezing, cross-border friction, and that geographic trap of proof of residence.
Then we identified the essential features for a modern traveler's crypto card: true worldwide acceptance, mobile wallet compatibility, and no hidden border fees.
And we saw how independent solutions like PintoPay are demonstrating the potential of that fintech category.
And on the other side, we covered the massive income opportunity from stablecoins, contrasting that minimal bank interest with the 20% APY target from the DeFi blueprint, and always remembering the need to distinguish between protocols generating real yield
versus those offering potentially volatile inflationary yields.
Right. So for practical next steps, we'd encourage you to use the decision framework we laid out. If you're focused on spending, identify which of the three crypto card types, exchange-based, fintech, or white label best, aligns with your travel habits and how you use crypto platforms now. And if you're focused on earning, dive into researching the difference between protocols offering that real yield. Analyze their audit history before you even think about deploying capital.
So a final thought to leave everyone with.
If we connect all this to the bigger picture, given the entrenched necessity for proof of residence that traditional banks demand for just basic financial access, what does the rise of truly global, border-frictionless financial tools like crypto cards imply for the future definition of national residency itself when your economic reality is no longer tied to your physical address?